Hello and welcome to the Deal Economy 2014. I'm Jeff Kanige, Editor-in-Chief of The Deal, and this is our Corporate Dealmaker Update. Joining me to talk about the current deal environment and what to expect over the next 12 months are some distinguished M&A executives with a wide range of experience both in the U.S. and overseas. Jeff Barton is Vice President for Licensing and Acquisitions at Abbott Laboratories. He was appointed to this role in 2013 and previously served as Divisional Vice President and Controller for Abbott Nutrition's global supply chain and as Divisional Vice President and Controller of the North American nutrition business. Since joining the company in 1990, Mr. Barton has held a variety of financial management positions across Abbott's businesses, including diagnostics, pharmaceuticals, and nutrition. In addition to his U.S. experience, he has served in regional positions in both the Netherlands and Singapore. Recently, Mr. Barton led Abbott's acquisitions of IDEV and Optimedica. John Doherty is Senior Vice President for Corporate Development of Verizon Communications and Verizon Ventures. He's responsible for joint ventures, strategic investment activity, acquisitions, and divestitures. For his current position, he was Senior Vice President for Investor Relations and has served as Chief Financial Officer for Verizon Services Operations and Vice President for Strategy and Finance for Verizon Business. In the latter role, he was active in the integration of MCI into Verizon and played the lead role in the company's acquisition of CyberTrust. As Vice President and Chief Financial Officer for Verizon International, Mr. Doherty successfully completed more than 20 transactions to rationalize Verizon's non-strategic assets in Europe, Asia, and the Americas. Roger Maranzoli is Senior Managing Director for M&A and Corporate Development at TIAA-CREF. Mr. Maranzoli has 20 years of experience in M&A and corporate finance, having served with public companies, private firms, and government entities. His M&A transaction experience has principally been internationally oriented, spanning the financial, hospitality, telecommunications, energy, and technology industries. Before joining TIAA-CREF, a Fortune 500 company in the financial institutions sector, Mr. Maranzoli served in the same role at Wyndham Worldwide, a hospitality company. He's also served as the CFO of a financial technology venture and as M&A and corporate finance banker at Lehman Brothers. Bill McNichols is Senior Vice President at Starbucks Coffee. Among his responsibilities, he oversees global corporate development, leading company-wide business development and mergers and acquisitions activities. While at Starbucks, Mr. McNichols has led deals for Evolution Fresh, La Boulange, Tivana, and along with Starbucks' investment in and commercial partnership with Square and the company's global yogurt partnership with Groupe Danone. Before joining Starbucks in 2011, he spent more than 5 years as a director of Vulcan Capital, the investment vehicle for Microsoft co-founder Paul Allen, where he is one of 2 senior professionals with responsibility for a multi-billion-dollar private equity portfolio focused on media, technology, and telecommunications investments. And last but not least, James D. Rosener is a partner in the commercial department of Pepper Hamilton, where he leads the firm's international practice group. He's also managing partner of the New York office and has served as a member of the firm's executive committee. His practice is devoted primarily to international transactions, private equity, mergers and acquisitions, and corporate financing. Mr. Rosener has represented domestic and foreign private equity funds and transactions in more than 70 countries, including platform and follow-on acquisitions, distressed buyouts, corporate carve-outs, and restructurings. Mr. Rosener worked in corporate finance field for 9 years before becoming a lawyer. Welcome to all of you. Thanks for joining us today. We want to spend the next hour or so talking about the year ahead, but I'd like to tee up that discussion first by getting an assessment from each of you about the current environment. Generally, the assessments have been all over the lot. We've seen some reports saying that the M&A environment this year was very strong, others saying it was disappointing, especially given some of the big headlines. John Doherty, your company made perhaps the biggest headline this year, so I'm guessing that you found conditions fairly favorable.
Certainly, it's a good place to start.
Okay.
Absolutely. In our space, we did a monumental deal. It was a transaction that we were working hard at for almost 12 years. I guess, in sticking with it, we were able to finally get it done. $130 billion transaction, as everyone now knows. But there are other deals in the space as well that closed. I mean, SoftBank came into Sprint. So I think if you look across the telecom space, it was a relatively healthy year.
Okay. And what did the Verizon deal say to you, Jeff, Barton?
Well, I think as a kind of a spectator of the M&A world, it was interesting to see what you did, and certainly it was exciting and informative. But each deal is unique in its own right, so it doesn't necessarily inform anything that we might be doing at Abbott Laboratories. We did have, I think, a pretty good year. We started the year off with a spin-off where we spun off our proprietary pharma business from our device and nutrition business. And that over the course, since announcement, has been about a 75% increase in the combined market caps of the two companies. So a very good transaction for us. And we've done some strategic transactions as well this year. So, I echo the sentiment that it was a good start, and we're looking forward to 2014.
Okay. A couple of votes for good. Mr. McNichols?
For us, I'll talk about Starbucks first. I'd say it was more of a year of integration.
Mm-hmm.
We closed Teavana in the beginning of the year, which was a sizable investment for us. But then it was really making sure that the things we had purchased over the last 2.5, 3 years are folded into the fabric of the stores, first domestically and then over time across the world. The one interesting thing I thought from the Verizon deal, which I would suspect that all of us saw, was that it highlighted the favorable borrowing conditions. Right. And we talk about that, and it's a different perspective than certainly the private equity side of the world. But with capital so cheap, it was an interesting time to evaluate opportunities like this. And it also, I think, for a lot of the folks at this table, it was a balancing act as we thought about returning capital to shareholders versus deploying with the capital markets as frothy as they were on the debt side.
And Roger?
I would say it was a year comparable to the last 3 years. I think you're right.
Good or bad?
Well, that I think is the question, because over the last several years, there has been an anticipation that after the financial crisis there would be a recovery. And in fact, there has been a recovery. We've been doing, on average, for the last 3 or 4 years globally, about $2.7 trillion. And this year, if you do a quick average analysis, we might get to 2.9, because by the third quarter, we're already at 2.7. So by the data that I was looking at, this has been a good year. Now, part of it is the lower financing environment. Part of it is the fact that cash is still clearly on the books of a number of players. And another part of it is in the mid-market, there has been a tremendous willingness in the last few years since the financial crisis of players wanting to sell out, wanting to find merger opportunities, and wanting to find joint ventures. And I think that is because there has been tremendous uncertainty in terms of the forecast of where the environment, specifically around the United States economy, is going to go. Now, I think confidence has certainly improved, and that sets us up for a 2014 period.
Okay.
I have to agree. I mean, after a crescendo of 2012 to beat the capital gains tax increase, it was a pretty quiet, at least in the middle market, first and second quarter. I think generally it was a time where the equity markets and the debt markets far outpaced anything that the M&A markets showed. Probably beginning around the middle of the summer, I think the M&A market has really picked up considerably, and it looks like it's going to be as strong of a year-end as it was last year, without being pushed by the artificial, tax change. Mm-hmm. So I think for 2014, there'll be a fair amount of inertia going in to 2014.
Okay, so a strong year. Roger mentioned confidence, which is something that I wanted to talk about a little bit, because that was sort of the most consistent aspect of what we were seeing, what we were being told about this year, was that confidence had increased vastly, obviously since the financial crisis. But this year in particular, confidence had grown among corporate executives, C-suite executives. What were your clients telling you? Did they seem more confident this year than they had been in years?
I mean, most of them are private equity funds, and they're definitely more bullish on doing deals and getting deals done. And if you look at the numbers, I think the numbers support that. I just anecdotally, last year, as it happened, was I have a board meeting in Paris this time of year, and I had one this morning, well, yesterday, and got back this morning. And last year, the general mood in Europe across was barely above suicidal. It was actually a fairly confident change yesterday.
Okay. I see a lot of nodding heads, so I'm assuming that there's agreement that...
Well, I think confidence, there's the broader confidence in market fundamentals and macroeconomics, but for the types of deals that Abbott does, they're more strategic and targeted type transactions. And what we're really talking about is the confidence in a given deal. And the macroeconomics play into that, but it's really how well you feel about a technology or a company or a geographic area that you're going after, and that's where you develop the confidence. And it's on a deal-by-deal basis. And so the ones that we've executed, yeah, we felt pretty confident about.
Okay.
Yeah, and I would agree with Jeff completely. I mean, if you look at what we did, with the wireless deal, I mean, that was a tremendous vote of confidence. We owned 55% of the company. We acquired the other 45%. It's a company that's growing at over 8%. And the transaction was all about the future of that company. We can talk about the performance that we've been on and the run that we've had over the last several years, but the transaction was all about us believing in the business and where it's going.
Mm-hmm.
I think we had an interesting scene of partnership and confidence in partnership that occurred in our own company. This year we did a transaction, largest one that we've done in the last couple of years, which was a real estate partnership with a British player named Henderson Global. And I think going back to James' comment, we also noticed that beginning at the end of 2012, that the confidence in Europe, the mood lightened, that partnerships, JVs, and outright acquisitions and flows of capital could be something that European companies could do. As a result, in the financial institution sector, you actually saw that happening more and more. In our own sector, where we worked as TIA, we are not really a vast global player. We are generally US-centric with a portfolio investment that is very global. But we took a first step of taking a foreign direct investment, the biggest we've done, in the UK on a global play. And that was all about confidence, because the mood at the end of 2012 for Europe was what was going to happen in Europe. By the middle, as you pointed out, of 2013, we were at TIA confident enough that we could see the future and we could say, okay, we have visibility, let's do this deal and this partnership, because as you were talking about, the upside over the long run will be strategically important to us.
Okay. And Bill, your company is sort of closer to retail consumers, the individuals, than some of these others. How did you gauge how are you thinking about that now, about your own confidence and consumer confidence?
It's interesting, and I would generally agree with the sentiment at the table. And I think the wireless customer is probably, you're pretty close to how that feels. But for us, we definitely feel more confident. I think we feel good about the performance of the business. We feel more confident in deploying capital. I do think we saw a stutter with the shutdown in October. And I think that it's a fragile confidence. I think we've been in this period for the last couple of years where confidence is increasing, but there's a sense of fragility underneath it, at least on the consumer side. How much can the consumer do? How much more can we hope the consumer is going to stretch? And that's the 14 for us and how that plays out. And I hope that we are spared from exogenous shocks that can really upset the, hopefully, momentum that we're building into 14.
Okay. What sort of things would you be looking for? What sort of shocks could really
well, I think
derail that?
I think some clarity on a budget deal would be helpful. And today might have been a good first step. It looked like there were some news reports this afternoon. I think that would be positive. I think that Europe has, by and large, started to stabilize. We see that too. And I think that the confidence level in October of 13 compared to October of 12 is an example, night and day different. And so, for us, we comped positive on the stores for the last quarter in Europe, which was, I think, tremendously encouraging for us. Asia's great, but Asia's great, and we're always waiting for what China will do, how capital flows will or won't change in the market. But generally, we're feeling really good, but it's underlined with this question of, is there a shock? How are we going to be prepared if there is? And then what kind of shocks to the system could there be? I see them as more exogenous, though, than anything else.
John Doherty, where would you, what could happen that could dent your confidence?
Well, I completely agree, and particularly if you look at our exposure, in the U.S. market, anything that would happen, any hiccup, like we've seen before, around the government getting a budget deal in place that could affect the markets, could affect where interest rates go, would be the main thing that we're keeping an eye on.
Okay.
And I would agree with that, actually, because at least from the financial institution sector, one of the biggest things that has been impeding companies in the banking and the insurance sector has really been the low interest rate environment. Great for consumers, great for stimulus for business, more difficult for companies that have effectively asset management under their belts that rely on fixed income. And so, whereas a shock would come to the system if interest rates rise, which people are anticipating, have been anticipating for some time, on the other hand, for the financial institution sector, that could be a sign of good performance, but not good M&A outcomes. And then I think lastly, the idea of regulation is very important for our particular sector. You saw a lot of changes happening in 2008. I think a lot of changes for the good. I think a lot of changes also that happened in the financial institution sector that has slowed down strategic planning and the ability to make certain choices about business models. Whether you're a bank, an insurer, an asset manager, you really can't be all three and do them well today. You have to pick where you're going to go. And that regulatory change, which always has some uncertainty, can certainly put a damper on the outlook for M&A for financial institutions for 14 and 15.
Okay. Well, let's bring the lawyer into that discussion.
Well, certainly the regulatory environment, a stronger Volcker rule, whether the large financial institutions can continue to invest their own capital in private equity and the like, will that cause a pause in a big part of the sector? Obviously, they'll sell those businesses, but I think that'll cause, at least at the top end of the market, some pause. I think in the more private equities, regulation continues, but I don't think it's really affected their ability to transact business.
And Jeff Barton, how does healthcare reform and the continuing implementation of the Affordable Care Act your thinking?
That's a really good question, actually. It does have an impact on what we're doing, because it used to be that all you had to do was identify a technology that was going to improve patient outcomes or improve quality of life. And that was, in the long run, going to be a strong strategic transaction. Now when you look at it, those things have to be there, but in addition, it has to, the technology or the play has to take costs out of the healthcare system, or else it will not get the traction that it needs to really pay out over the long term. So now when we look at a transaction, it's always with that lens, and it adds just another level of complexity to it. You really need to understand the reimbursement environment and make sure that hospitals are going to be making money using a given technology, and only then can you go forward and move.
And the CEO of your company has said that you're out there looking for acquisitions.
Yeah, and we are, yeah. And we actually see at this time there's a lot of technologies that are just maturing in a variety of different spaces across med tech. So it's a very exciting time for us to be out there looking at assets. And what I think is becoming difficult for a lot of the startup companies that are trying to exit at this point is the reality that the healthcare system can't afford their technologies. And that's unfortunate, but it's our job to find the right ones that will work.
Right. And of course, there's going to be midterm elections next year. Are you thinking about those? When do you start paying attention to those? Do you start paying attention to those? Are you interested in the outcome of that, Bill McNichols?
I mean, for us, the first answer is, like any participant, we're going to be interested in an outcome. As an individual, we all would be. As a company, we're more focused on running the stores the best we can and delivering value to the 70 million people globally that come through every week. And thinking about the elections as a special event is not part of the fabric of running the business. I do think that clarity is good. I think that clarity in terms of a path to some more coherence in Washington is positive. And I think that all those become incremental steps, which helps M&A, it helps confidence, it helps cash get deployed. But in and of itself, we're vested in the outcome as individuals in the system, but not from a corporate standpoint.
Right. I guess what I was getting at was the whole idea of uncertainty. That if for example, one or both houses of Congress were to change hands, and that became clear that it was a possibility, would that enter into your thinking at all?
I don't think so, unless it led to an inability to move again, which is really what we saw. And I think we talked about this with our results. We had a record year, but October was a weird month with the shutdown. And I think that it was, it just felt very weird, and consumers, I think, really were bearing the brunt of a process that wasn't working, and it wasn't fair to them. And where we are now coming out of the recession, I would just hope that folks are looking for clarity so that the sort of step-by-step growth we see can turn into something more sustainable. And we'd applaud that. We think that would be great.
And Roger, financial services is, always one of the favorite topics in Washington. How are you judging what?
It's an interesting question to ask because, of course, any prudent financial institution would be very careful about how they would look at either side of the party, whoever is in power. But I think the correct answer to what financial institutions in general seek is stability and rationality. I'll give you an example of something that really affected TIA as we have been going through these now semi-recurring crises on either the budget or the debt ceiling. We are one of 7 AAA-rated companies in the country. We had been notched downwards because when one of the rating agencies reduced the U.S. government's AAA plus rating effectively down, we also got moved down. And we could imagine what the ramifications would be. It's not a simple mathematical rebasing. It loses tremendous confidence in the U.S. government itself as a rational place to do business and investment, especially with the large amount of historical debt that we have. And so that kind of stability and rational thought about getting the economics right for the country and setting up the financial institutions to service our business partners in other areas of the industrial sectors is something that we really are looking for. Okay. Not just the TIA, but across the financial institution industry.
And John Doherty, your industry is also one that is high profile. It's one that consumers can complain about or love or hate. Sure. and make that clear to their
We like the love part of it.
Okay.
No, I mean, I absolutely agree with what's been said already. I mean, certainly we have to manage the local, state, and federal environments that we find ourselves in, both from a political perspective, regulatory perspective, et cetera. But, at the end of the day, I mean, we're going to do what we think is right from a strategic perspective. If we're out there in the market and we're focused on building our platforms, building our business, providing a better service to our customers, we're going to do what we think is necessary to do that, whether it's the organic capital program that we have or the inorganic activity that we do on a fairly regular basis. We may have to do things a little bit differently, we may have to adjust or pivot a little bit, but we're still going to do what we need to do to get what we need to get done and improve value for our shareholders along the way. Okay.
And you all have experience overseas, so looking beyond our borders. James Rosener, is there anything that's on your radar outside of the country that could really dent confidence?
I think a lot of the talk in Europe is investment opportunities in Spain, where unemployment's 26%, youth unemployment's 52%, but people think that it's getting close to bottom. Same in Italy, Portugal, likewise. I think that France, they still have a problem with their tax rate, their labor issues. They're not getting any better. They have a fairly serious disconnect with the views of their president. They've realized that Sarkozy wasn't so bad now that they've replaced him. And Germany continues to charge ahead, but on tough negotiations for their coalition government, which they ended up having to give far more than they expected to give. So I think there's a path up from the bottom that people are generally seeing. Smart money is starting to get raised to invest in that, and I think that will continue. But there's going to be some pockets like France, like the Netherlands, where it might not be so bold.
One really interesting thing for all of us, if we're thinking about transacting globally, is call it exchange rate volatility. And I think that that's something that we think about, we look at, and we have had a policy with the Fed, which has really driven safe haven in the States, and it's changed the basket globally. So that didn't used to be something that was on the checklist as we thought about opportunities, but now currency translation is something that we spend a lot of time thinking about. I don't know if the rest of you guys feel the same way, but it's not the policy implications, whether it's Abenomics in Japan or what's happening in Europe or what we're doing with the Fed and what taper ultimately does or doesn't do. It becomes a bit more complicated to manage interest or to manage the currency as we're thinking about cross-border.
Right. I mean, anybody who invested in India at 43, at 67 didn't look so good. It looks a little bit better now, but it's still a 50% delta.
I think one thing that really matters in terms of how you think about foreign exchange, and I think this gets to be a very complex discussion because foreign exchange in terms of
let's
the
go there.
reporting.
You want that?
And I think we all have enough experience
with
around the table to
with
do
translation.
it. With translation matters for shareholder value. But on the other hand, if you're looking at actual cash value on a relative basis as a foreign direct investor, then you have to make decisions about permanent reinvestment or thinking about repatriating capital. That's a tax-driven decision. And so when we think about going overseas or we think about the overseas environment as US-based companies, it's not just about the foreign exchange, it's also thinking and driving where are tax rates going to be lowest, and should I be thinking about keeping my business overseas or should I bring it back to the United States? It becomes a very complicated decision, but it's becoming more and more important as the world has tremendously globalized. We all remember what it was like in the 90s, where there was a surge of internationalization. And then it has even grown even further, even though cross-border investments are down a little bit since the peak a few years ago. That, I think you mentioned on one of the discussions we had before this discussion, James, that every deal now has some cross-border component. And that's one of the features of it.
Yeah, and the driver of all those is how do you finance, especially when it's a private equity fund, how it's financed. How are you going to use, foreign earnings to repay debt without having, an inadvertent, repatriation tax in structuring that. And it's, half the structuring of the deal is figuring out where the financing is going to be, what's the structure of the company, what's the top co, will it be a foreign company, will it be a U.S. company, and there's all different drivers on every different deal depending on where people expect the profits to be.
Abbott has basically looks at currency volatility as one of the costs of doing business in emerging markets. And we have a strong emerging markets focus right now. About 40% of our revenue is coming from emerging markets. And, for example, we're getting hurt this year by India and the rupee. However, a bad day in an emerging market is often better than a good day in a developed market, and we're willing to take that risk and deal with that volatility, knowing that the long-term prospects of growth in that country make it pay out. So that's our philosophy.
And John Doherty, your deal was a cross-border deal. I mean, you were dealing with Vodafone, and there was a long piece in the FT this morning about one of your competitors and what their thinking might be in terms of going after Vodafone. How does your company view the rest of the world and what might happen there?
Yeah, I mean, first on the deal itself, while it was a cross-border deal in a sense that we were buying out a foreign share owner, it was still for a U.S. domestic asset. So in terms of increasing our exposure to risk or anything like that, I mean, certainly that wasn't apparent in this transaction. But we are a global company. We've been a global company for many years. I think, I agree with Jeff again. I mean, it really comes with the cost of doing business. I think you have to look at it in terms of, are you going into a new market for the first time? You might want, you look at it a little bit differently. Are you in that market and trying to expand within that market? What are your revenues denominated in it? Because it's not always in local currencies. There's a number of factors, but if you're chasing growth, you need to do it prudently and you need to account for it.
We've mentioned a lot of countries by name, but not China. That elicits chuckles. So what about China? How closely do you pay attention to what's going on in China? How important is China and what happens in China?
China is enormously important. It's just such an important market, and all the demographics are going the right way for a company like Abbott. It is a challenging place to invest due to some of the regulations that the government has pursued. It is challenging to invest there because of the valuation of companies there. So it requires a lot of work, and frankly, I think we've got more to do there than what we've done already. But it's certainly not easy in China. I'll say that.
Bill McNichols, you were there, or you're going back there?
Both.
Okay.
We
give us a report from China.
Yeah. We recently opened our 1,000th store in September, and marked it with an amazing flagship in Beijing at the Kerry Center. We love China, and we love participating in the Chinese economy. I do agree that pricing for private companies there or companies there is extraordinarily high, but I think that the opportunity as we think about where Starbucks will go, China's, we've said publicly, hopefully our second home market. and we added slightly over 400 stores last year, and we'll add something similar to it this year. It's a great place for us to do business, and I think, at least for us, we've found that our success is in making sure that our partners, our store partners there who work in the stores, are really buying into the culture that we have, and they're part of a big business with a Chinese angle, and it's really resonated for us, and it's a powerful market.
Mm-hmm. I mean, what we're seeing our clients looking at, it's changed in the last 10 years from a export market to a consumer market or a domestic market.
Changing. I think it's still changing.
It's still changing. Mm-hmm. And so the valuations that you're paying for this, billion, person population growth hasn't yet been proven, but the valuations are reflecting that it's going to be a fairly short term that it starts getting realized, but it's not yet realized.
Whenever I'm there, it always strikes me, and I think one of the challenges is I see Shanghai or Beijing or Guangzhou as opposed to some of the secondary and tertiary markets where I can't, and I don't know if that consumption is happening the same rate, but in the primary cities it is turning into a consumption economy, domestic consumption, which is wonderful to see.
Yeah.
I think China plays very well in terms of looking at future and current demographics in the consumer or industrial markets. But when you look at markets that are regulated, or even markets like real estate, it becomes difficult to do business in China, certainly for financial institutions players, because the regulatory regime is just not as clear as it would be, say, in Europe or in Australia or in Singapore. And in the real estate market, for example, when I was doing real estate and looking at deals in China, you had difficulty on ownership rights. You couldn't own the land. You would be leasing it for 20 years. And even on a long-term project, even though you can see it for 20 years, if you think longer term and you're uncertain about what litigation rights are, and the same, of course, is true in the IP world, right, for intellectual property rights. China poses some great opportunity, but I think there's a lot of risk that deters investment flows from going there.
I agree with that. Trademark management in China is critical.
It's very difficult.
And it's not just China. I mean, I think Thailand, I think Southeast Asia collectively plus China, trademark management matters a lot. And we see that every day.
Represented a company that made a very well-known brand consumer product, and the biggest counterfeiter of its product was its own factory.
Not surprising.
Yeah, and for us, I mean, China's an interesting market. It's unfortunate that we're actually not able to own network in China. So for us, it's all about partnerships, managing alliances. We have a very strong partnership with China Telecom. We can do value-added services above the network, so we do have people there. But it's still a market that we are waiting to open up and to provide us with even greater opportunity as we go deeper into that market, because as companies like those around the table expand into those markets, we want to be able to go there with them.
Okay. Let's come back home for a bit and talk about valuations. We mentioned that a little bit. Where do you see, we'll talk about public company valuations, the trajectory of the U.S. equity markets. What are you looking for next year? How will that affect valuations? How is that affecting the way private equity is thinking? Maybe we can start with James Rosener about the frothiness that we've been hearing about from private equity firms.
I mean, part of the driver of valuation is financeability of a transaction, and that's certainly going back to 2007, 2008, not quite there yet, but getting close. So that's going to drive the top, and the people's willingness to put equity that matches the debt, can generally drive 4.5 times plus 4.5 times equity. You're back up above 8, closer to 9 times multiples that people are seeing, and that. Other than in distressed assets or carve-outs, which we do a lot of, that seems to be where the pricing is, coming in. Low interest rates, high financeability has driven prices back up.
And
yeah, there's a lot of money has flowed back into the equity markets, and it's generally had a pretty significant impact on the affordability of commercial stage assets in the U.S. We tend to focus more on development stage assets, which means we're competing more instead of with the open market, more with venture capital. And back to kind of what I was talking about previously, there's not as much venture capital in med tech as there used to be. And it's actually created a unique situation where there's more opportunities for companies like Abbott or other healthcare companies to go in and make equity buys at kind of the venture capital level on startup companies, get to know them well, to kind of take them through development and then buy them before they really become commercial and then subject to the greater market forces. So that's actually worked in our advantage over the kind of the short term.
And Roger, financial services companies must be paying close attention to all of that. And how do you see it shaking out next year?
Well, I think starting the beginning of, well, let's call it the middle of the year after the hike in interest rates, there has been this surge in the equity markets. And I think that you have several scenarios that we can outline, one of which is that if equity markets continue to go strong, which it's reasonable to expect at least through the first quarter that they would, with a lot of money coming back, continuing to come into the markets, you will get M&A deals priced out of the market because they just get too expensive.
Right.
We look at our own sector in asset management, and asset managers were going for about 7 or 8 times a few years ago. Simply because of the aftermath of the financial crisis, they're now trading at median levels. This is EBITDA multiples of somewhere around 12. So that surge impedes cash deals. What it does do, though, it does open up opportunities for strategic deals to be done on a stock-for-stock basis because the rising tide has lifted generally all sectors. So most companies are experiencing strong valuations now. So on a stock-for-stock basis, you could have a stronger strategic play within all sectors, I would say, for next year. So those are the two effective scenarios, that the stock prices continue to rise, and if interest rates begin to come up, that will impede the financing that we've been talking about. So while it can look bullish, and there is confidence, at least from the surveys and in my own peer-to-peer discussions, I think there are some things that could definitely trigger, and they're not exactly the large macro exogenous changes, but things like the stock deal, things like cash being impeded as prices rise, and things like changes in the interest rate could really change the outcome next year.
John Doerr, do you see it the same way?
Generally, yeah. I mean, I'd like to have our cake and eat it too. I mean, we certainly have benefited from having a strong, healthy market, low interest rate environment, going back to where we started, with enabling our ability to complete the complete the agreement to acquire the 45% of Verizon Wireless. But absolutely, it could also be a little frothy when we look at certain spaces that we want to expand into. No question.
Consumer side is the same. I would say it's fully priced, and I think that a lot of the private sellers now have, at least in the sectors we deal in on both the retail and the consumer side, they've got these marks that they can look at in the public markets over the last 18 to 24 months, and they use the marks in their minds and say, well, I'm like, I should trade at. And that's great psychology from a sell side standpoint, but on the buyer's side, it's all about growth, and it's all about proving out that growth. And I think that the onus is, the onus candidly is on the acquirer to make sure that you're comfortable paying a frothy full multiple so that growth materializes. Because if you're not seeing it on the cost side, I'd just be very skeptical of revenue synergies. I always have been, and I will be.
Right, and all models are the same, and certainly in the private equity world, somebody wants 12, 13 times multiple. Nobody's going to show up to really bid, and you'll see that deal 6 to 9 months later for more normalized pricing. Now, if there's a strategic with a strong stock and a strong multiple on a stock who wants to buy that, it's going to trade. But
I think the interesting thing, at least on the consumer side, is there's been a ready IPO market for a lot of the companies that couldn't have gotten an M&A deal done at whatever steady state multiple was. The IPO market has actually bumped it, especially with the first day pops we've seen. And that's great, and I think the retail investor is voting with their feet, or someone is. But it's changed the dynamic where you think a market clearing deal might be 10 times, say, and you see a company go and it's an effective 12 or a 13 or a 14 times multiple. It's hard to say no, but you just have to let it pass.
It's an interesting question, what happens to the composition of deals, large deals like yours, and smaller deals, because as, let's say, valuations continue to rise, you do run into problems of getting large deals consummated. People remember, people like us who've been in the industry for 20 years, we remember the 90s, and we remember the studies that came out of, for example, I was in the telecom sector, the multi-convergence deals that were coming out of the 90s, and some of them didn't work out. Surveys will talk about 60% of mega deals that didn't work from the 90s as they evaluated the aftermath in the 2000s. So this year, we actually had 18 large deals that were over $10 billion. That was much more than the last couple of years. The question is, as prices continue to rise, if they continue to rise, do you still see those large deals happening next year? And we don't know the answer to that question, but again, bearing in mind that many people are concerned about how large deals will work out, the pricing and that construct may impede big deals from happening.
Mm-hmm. Yeah, I mean, given we're sitting here in New York, I mean, if you look at what the Yankees just paid for Ellsbury, I guess at some point in time you just got to be prepared to say no.
Right.
You know, and
that's right.
So just to echo your point, yeah, you just have to be prepared to say no. I mean, you cannot fall in love with an asset. You have to be able to walk away, and you need to make sure that you have. If you particularly wanted to expand in a certain space, add a certain capability, you need to have more than one asset on the list.
Okay. And Roger, you mentioned interest rates, and a couple of other people have mentioned the possibility of Fed tapering. I'd be remiss if I didn't ask about how you're thinking about the Fed and what it might do next year, and what kind of calculations are you trying to make as you listen to what they're saying?
Sure. I think one of the things that I brought up before, which is true, let's say, of insurance companies and banks, is that the lower interest rate environment, especially if you're holding fixed income assets, creates a problem for your equity holders, right? You just don't get the returns. So from a performance perspective, seeing interest rates ride modestly, in a graduated fashion, would be a good thing for equity holders of insurers and of banks. There's no question about that. However, from M&A transactions, one of the things that has enabled us to have a relatively good run of the last 4 years of this close to $3 trillion in volume, relative to, let's say, the first half of the 2000s, where you didn't even get to $2 trillion of deal volume when you had a much higher number in the 90s. And a lot of that had to do with the use of financing and where interest rates were. As we saw interest rates come down and you saw the prevalence of financial instruments being used in the 2004, 2005, 2006 period, you had this massive run-up in terms of M&A. You had $4.6 trillion of M&A done in 2007. Now, a lot of that financing, and as we all know, was done for the wrong reasons. But on a moderated basis, if we do have some interest rate going up, my sector would like that. From the M&A perspective, it generally would be an impediment to getting more deals done because you do have low-cost financing.
Jeff Barton, how is your Fed?
I would say that because of the nature of the deals that we're trying to do, if interest rates going one direction or another impacts the rationale or the doability of the deal, then we're not finding provocative enough deals. I mean, it's really the strategy and the fit with the company is so much more important than kind of the kind of statistical wobble in interest rates. So that's not what we talk about when we're doing deals.
Okay.
And it's the same even in the leverage world, where obviously interest rates are important, but they're not the driver of the deal. It's no longer financial engineering.
Right.
It's operational performance. It's rationalizations of the businesses, consolidations. And if you're looking for an 18-20% return on an asset, the difference between 8% debt and 9% debt,
right,
or 10 really doesn't drive the decision. It's much more. Can you operationally turn this thing around?
Bill, you had started to.
We would not, from an M&A standpoint, use interest rates would just not be even part of the discussion because I mean we're largely still quite cash heavy. The other thing I would say though is if interest rates rise modestly, there's likely the downdraft in the equity side as the risk-free rate goes up.
You're right.
I'm okay with that because I do say in the consumer space especially, I do think there's a spread or a disconnect between what private market value looks like and what some of those folks might think comps are on the public side. And I think a narrowing there is probably a good thing for deals. Now, like everyone else, I'm a representative of a publicly traded company, so a higher risk-free rate means a lower the discount rate matters for all of us. But for deals, a little bit of a rise, I might see that being a good thing.
Okay. John Doherty, do you agree?
No, I would agree. As long as what's driving a rise, if there's positive indications
Yeah.
of the broader economy, then, well, I'm not saying all for it, but as long as it makes sense, certainly.
Moderate, a little bit.
Yeah.
Okay, at the outset, you all said that that this year had been a strong year for you predicted. You felt as, at least you told me, you felt as though next year would be strong. What would a strong M&A year next year look like? Would it be a lot of big deals, or higher numbers than we're seeing? I'm putting aside $130 billion, not numbers in those neighborhoods, but close to it. Or just a lot of smaller deals. What would a good, solid M&A market look like to you next year?
The one thing I'd say before you get there is it's not fair to use buying in 45% of a business you already own as a big deal.
I agree.
You guys knew
Agree.
that asset so well. You knew
Absolutely.
everything about that.
The diligence we've had to do on other transactions was much greater than we had to do on this transaction because we've owned the asset, we run the asset. You know, Vodafone for years has really been a financial investor. It's been a great partnership, but I certainly agree. I mean, just to keep going from our perspective, and so put the $130 billion deal aside.
That's what I was trying
Yeah.
to do. Put it aside.
Absolutely, put it aside. I mean, I do think it's going to be a decent year. I mean, particularly, I think you're going to see a lot of things happening, continuing in the telecom space. For us, I would expect things are going to be smaller, not smaller in the context of the $130 billion deal. Just it's going to be more about buying in capabilities, you know, buying potentially people, filling in gaps that we have within our portfolio, adding to the platforms that we have, so that we can put a better service into the market. And you don't need to do $40, $50 billion deals to do that.
Okay, Bill, we put that aside. So.
Well, I would just say that for us, I completely agree with that. I think that we would probably have the perspective that small to mid-sized deals feel right from an execution and an integration standpoint because the devil is in the details. It's easy to buy something, you just pay the most money for it. And as a strategic, people expect that. The hard part is bringing it in and folding it in and making it work inside the existing bigger business. And as you go up in size, the complexity of that integration increases exponentially, I think. So we like the small and mid. I suspect we'll continue to look really hard at those to fill in pieces of the portfolio. And we'll also, I think, be judicious in using partnerships where we don't want to put capital out. And that's one thing we haven't really talked about, which is a lever that we have to pull is major corporates where you can find somebody who does something else really well, and you can do it in a way that hopefully both of you are winning at. Harder to do them. They're much harder to find win-wins, but it also is capital light, I think, potentially a higher return.
Okay.
That's a good year for us.
Okay. And Jeff Barton, your company's on the prowl, as it were, so what's a good year look like?
Well, like I said before, there's a lot of maturing technologies that are out there in med tech that I think we'll be looking at pretty closely in the next 18 months. And so I would expect to see Abbott making some transactions in kind of startup companies. But also I think we'll be interested in expanding emerging market presence and just continuing to build footprint in Asia and Latin America.
If I could just add one thing as well. I mean, a lot of times the focus is on the acquisition. I think it's very healthy when companies look at their portfolio and sometimes try to prune the trees.
Yeah.
And some of the most strategic transactions companies can do are divestitures. So I think when you look at whether or not a market is healthy, I think you need to look at it. I know there's a buyer and seller on each side when you look at the transaction pool, but I think we've typically talked about it from the acquisitive perspective. I think for companies in our space, don't be surprised if you see us shed an asset or two as well. I think that's healthy.
Okay, James, you actually have mentioned this before. You see the same thing?
So yeah, in the buying side, the areas where we're seeing are carve-outs from companies. Those are the deals that, frankly, private equity loves because once it's decided to sell a business, a strategic to sell a business, that it's just a matter of when it gets done, not if it's going to get done or at what price it's going to get done. It's going to be a deal that gets completed within the quarter that they've announced the divestiture. So that we're seeing more and more of for the reasons that you just said. And these are large, complicated deals because you don't have an infrastructure. You're not linked to the mothership anymore, so your human resources, your legal, your accounting and finance systems are all severed. So it's having an experienced buyer that knows how to integrate that business, how to get through a transition services arrangement for 3, 6, 9 months to sever the cord quickly, move into your own space. Those are all attributes of buyers that can generally get a transaction done quickly and effectively and at a fair price that can cause pay for that recreation of the infrastructure. Okay. On the middle market side, while you don't see as many headlines on the middle market size,
well, we love the middle market. Middle market is bread and butter for us. So.
Right, and that's where the deals, in the number of people working on deals, the number of deals that get done, it's the bread and butter of most law firms, most investment banks, most financial institutions who are financing them, and those are the deals that really did go from a slow start to what seems to be a strong finish and hopefully a strong start for next year.
And Roger, a strong M&A market from your perspective, what would it look like
next year?
For next year.
There's an interesting phenomenon that I notice has been happening since about 2008, that even though deal volume has generally remained steady and may pick up for next year, that's measured in value. You talked about number of deals. And what I've seen happening is almost on a secular basis for the last 4 years, the number of deals that are actually getting closed, even though volumes, especially in the last quarter, have been going up, the number of deals have been going down. So we clocked about 27,000 deals in these 3 quarters of this year, which may take us, depending on how the fourth quarter actually results, into a 30,000 deal number for the year. And that's going to be at one of the historical lows. So what's interesting is that the question becomes almost that Stephen Colbert question about AT&T and Singular. I don't know if you remember seeing that, where there was
we remember it very well.
the massive consolidation, right? And, are you at a point where there are no more assets left to buy in a certain amount of time? Mm-hmm. We look at the banking sector, and we had something like 30,000 banks in 1985. We have 7,000 today. So it's becoming more and more difficult to necessarily find industries that are not consolidating. But I think that phenomenon of maybe fewer deals next year in terms of number, but the volume will probably go up next year. I think that's a strong M&A market. And I think the other feature to it is what a few people around the table mentioned, the consequence and the use of partnerships, whether joint ventures or strategic alliances. I think strategic alliances were misused in many ways in the 1990s and were unwound in the 2000s. But in my sector, I've seen more and more use of joint ventures and strategic partnerships. So that would constitute a good year next year.
And what could change your mind about that assessment? What's the one thing you worry about most when you think about next year and you've got your plans and you're traveling all over the world and you're thinking about what you're going to do? What is the most, when you stop and think, okay, everything's going to be fine unless this happens? Is there one thing or is it several things? Bill McNichols, what do you think about? What keeps you awake at night?
Well, for us, ultimately, we live and die with the consumer, whether it's in the stores or down the aisles in grocery stores. And I think that we feel really good about the year we've had and how the consumer has responded. I think that we are very focused on making sure we do everything in our power to exceed expectations, because we do still think it's not as resilient a recovery as we'd want it to be. And clarity from the government, clarity on a path forward, these are all really positive things for consumer confidence, better employment numbers. If we get that right domestically, that's still the engine of us. It's 75–80% of the profit of the business. And then in the emerging markets, it's building and growing in China, Asia Pacific, and stabilizing and recovering in Europe. But really, the bulk of what we'll look at for next year is the U.S. consumer. Okay.
James Rosener, you're sort of paid to worry, so what do you worry about?
The thing that affects deals the most is volatility or lack of volatility. If people feel like it's going to be a stable 6 to 9 month environment, I think deals are easier to do. People are more willing to invest in a deal. With volatility, your deal risk increases, execution risk, financing risk, the ability of the seller to actually show up at closing all changes. So if we have spikes in volatility, I think that'll affect the deal market most.
John Doherty, what do you worry about?
No, I mean, I agree with what's been said. Really, not a lot to add. I mean, I can't. We're exposed to the consumer market, enterprise market, wholesale.
Which seems like you should have a lot to worry about.
Well, we're longer domestically. We also have investments overseas. So, we feel very comfortable that we're pretty well positioned. I mean, if you say what was the single biggest thing that we worry about, it's Washington.
Jeff Barton, Washington, or something else?
No, it's not really Washington. Again, it gets to execution on our deals. And, if I'm looking, for example, in an emerging market, diligence is much more difficult. In some countries, transparency isn't what it is in the U.S. or in Western economies. And, there's always a risk of the unknown when you do a transaction. And so if you ask me what I worry about, is I worry that we do a transaction that we didn't uncover something in due diligence that we should have. And, I feel like we have an extremely strong, thorough diligence process, but that's what worries me, is that we might miss something. Or if we're investing in a technology, will that technology make it to market? Will it be reimbursed? Those types of things. Those are the things that keep me worrying about deals. But again, I think it's in our wheelhouse to control that risk by just diligencing the transaction properly. But there's always things that can go wrong.
So there's nothing out of your that's out of your control that you.
Well, I mean, clearly, there, reimbursement is out of our control, things like that. So no, there are plenty of things that are out of our control, but our job is to understand it, right, and understand the risk when you go into an acquisition.
Okay. And Roger,
I think
worries?
There's two answers to the question. In terms of getting M&A deals done, it's pricing. What is the pricing going to look like for assets in the financial institution space next year? That's the worry that we have. In terms of performance, like many people were talking about, as a AAA-rated company, and a pension company, we hold people's future lives in our hands. And so we worry very much about where the global economy is going to go, like all companies do, but in particular what Washington and the Fed are going to do, because caring for our customers is really important as a performance matter, and we are a private company that had been bequeathed the trust of Andrew Carnegie. And so as this not-for-profit private entity that's a Fortune 100 company, for us it's about the AAA rating and making sure that the global economy, whatever happens, that we maintain that stability for our clients. That's the big one for us.
Okay. And if we were to gather this panel again next December, what do you think we'll be talking about? Will we be talking about Washington? Will we be talking about China? Mainly, I mean, with the main topic of discussion. Will it be Washington? Will it be the elections? Will it be China? Will it be Europe? What do you think is going to be?
Well, we started talking about the elections, the week after the last elections, and I think we're, just like Christmas starts in September now rather than November.
I agree.
I think we'll be talking about that for sure. I think we'll be hopefully looking at a good year in the M&A, but everything goes into cycles. Will it be still on an upswing? Will it be tapering off? It's too early to predict.
Bill, you said you agree, the elections?
I suspect that confidence and clarity out of D.C. will still be a lot of what we talk about. I think that we can always hope that there's some sort of grand redo of the tax code and the budget problems would be great. I think a lot of people have money sitting overseas we'd love to bring back and use prudently. But that's sort of a pipe dream, I think. Beyond that, what seems to me most likely is that the U.S. continues to muddle along. There's not clarity. I don't think there will be. I just hope there's not more of what happened in October. And I think Europe will hopefully improve, and Asia is largely, I think, two pieces. It's the China question and how they manage their growth, and then what happens with Abe in Japan.
And John Doherty, we're not going to talk about a $130 billion deal.
What 130 billion?
But what are we?
Which, by the way, was a very big team effort. So
okay.
I'm here representing.
I know. I understand.
Very big team.
I remember the team very well.
Right.
The list that we had. So yes. What do you think we're going to be talking about? The elections, Washington.
All the above.
All the above.
Because we like to talk.
I think we'll be talking about the predictions that we made this year.
Well, that's why
we'll see
we're.
what happens.
And Jeff Barton, are we going to be talking about a website this time next year? Healthcare.gov, is that going to be all said?
I hope not.
So we won't be talking about healthcare reform or anything as far as your...
Well, certainly we will be. We'll see how that all rolls out over the next 12 months, and that will impact things in the U.S., but I think there'll be a lot of very positive things to talk about as well in emerging markets and new technologies.
Okay. Roger, anything else to add?
I hope we have a strong M&A year next year.
Yeah, good luck to you guys.
All right.
With reasonably priced deals.
Exactly.
Yeah, right.
Nothing that we have to leave aside. Okay, I think our time is just about up. Thanks again to our panel, Bill McNichols, Roger Maranzoli, John Doherty, Jeff Barton, James Rosener, and thanks to our video audience. Thanks for watching. In New York, this is Jeff Kanige for The Deal.